Well, it's shaping up to be a bad day on Wall Street. Stocks this morning opened below 2,800. I should say the S&P 500 specifically opened below 2,800, and that is a key support level. Now, some of you may be asking, this is generally a foreign policy focused channel. What am I doing talking about stocks? And I assure you that this stock market news does have something to do with foreign policy. So the significance of the S&P index falling below 2,800 is that it sends a signal to traders that they should still sell stocks and that stocks are going to continue to go down. Typically, at any given time, stocks trade within sort of a range of a price, and if you see the price move significantly outside of that range to the upside or to the downside, it sends a signal to traders that, hey, we should either buy more or sell more. And so if we close today below 2,800, that will send what is known as a sell signal to traders. And this is not exactly out of nowhere because there's been quite a bit of bad news lately. The long-fabled U.S.-China trade deal failed to materialize. Hopes that there would be an end to the U.S.-China trade war have been fueling a lot of the rally in stocks over the last couple months. And it is trade talk optimism that largely saved the market from a worse sell-off at the start of the year. Stocks were down nearly 20% from their highs at the lows of this year. But trade talk optimism managed to help them get back up to where they were before at their previous highs of, I believe, October of last year. And they actually made new highs at the start of this month, I think. But of course, in my opinion, that those wide swings in prices are the result of speculative mania, not any real, economic growth or anything. It was a mania predicated on trade talk optimism. And now that optimism has gone away, so too shall the gains of these last few months. If you think back far enough, the sell-off in stocks originally started because the Federal Reserve was engaging in rate hikes. And the reason why that was taking air out of the stock market is that the stock market itself really has been one big credit bubble blown by the Federal Reserve since March of 2009. As I've stated time and time again, the goal of the Federal Reserve under Ben Bernanke and then Janet Yellen, and now Jerome Powell, I would assume, was to blow a big stock market bubble so that people would feel like their 401ks are going up and that they're doing well in life, and so they would be optimistic. And if you have good consumer optimism, if you have high consumer sentiment, well then the economy is going to perform well because people are going to go out and spend all their money and not save it. For some reason, Keynesian economists think that saving your money is bad. They want you to get a bunch of credit cards and take out a bunch of loans and get a home equity loan and a second mortgage on your house and lever up as much as you can and just keep spending money. So in order to precipitate this, in order to promote all this debt, the Federal Reserve keeps interest rates very low by printing money. Low interest rates, then, are the opiates of the markets. They make everybody feel nice and calm and give people the impression that stocks will always go up. However, that changed at the end of last year. People started to become quite pessimistic because rates were rising, and I think that the market this time around has a bit more of an understanding as to what sort of a position they're in. I think a lot more people see the bubble this time. They may not call it a bubble, but they understand that Fed inflation is what's keeping the market high. That's why it started to deflate, and the only way they were able to keep the bubble from completely popping was by stuffing it full of more air from this trade talk optimism. Trade talk optimism fueled stock market optimism, and stock market optimism fueled, optimism in the rest of the economy. However, now that trade talk optimism has reversed, the stock market optimism is reversing, and that may accelerate. The pessimism may continue to grow. Right now, we're only 5% off the all-time highs, which is not very much. But considering how fragile the market is at this given point in history, historical norms really don't apply. Interest rates are still at historic lows, but people feel that they're quite high relative to what they're comfortable with. The market is extremely fragile and could collapse at any time. Now, with that said, the market also could go on as it is and sort of peter along for quite a while. But when you see the S&P busting through support like we have today with 2,800, that's when our feelers need to go up, and we need to start paying attention. Because if stocks start falling, the economy will follow, and if the economy, if pessimism, because really that's all that we're worried about really is perception, because in real terms the economy hasn't been doing well for a long time, but people are optimistic, and that's what matters. That's what matters in politics. That's what matters in elections. People feel good about their future. I mean, that was the whole idea of trying to prop up the stock market after the 2008 crash. Make people feel richer than they actually are. Give people a false sense of prosperity. Now, since being elected, Donald Trump has fully embraced this model, and he's completely embraced the bubble. The bubble really, he's got a big Trump T plastered on this stock market bubble and on this bubble economy, so he can't afford to let it pop. However, if it does end up popping, if that's what we're seeing now, and I think we've been really in a slow motion crash here for quite a while, I think conditions have visibly decayed, even if stock prices actually haven't. We may see the president get somewhat desperate. The president knows that if the economy comes apart, that he will be backed into a corner, and that he will not have a lot of great ways to try and win re-election. Now, he'll try and deal with this domestically and lean on the Fed to try and blow another bubble, or maybe lean on Congress to blow up some big stimulus bill like Obama had, but probably twice the size. He'll pull out all the stops to try and reverse the crash, but in fact what he'll be doing really is prolonging the crisis by not sort of letting it burn. Situations like this you kind of have to look at like California wildfires. In California, and it used to be like this in many other places, if somebody starts a fire, or if a fire starts in the woods, they try and put it out immediately and don't let the underbrush all burn off. But what ends up happening is that over the years, as they let more and more underbrush accumulate without letting it burn, you get all this kindling that is just liable to go up in flames at any moment. And once it does, it burns hotter than you could ever imagine. That's the position we're in now. Every president tries to stop recessions from occurring. They try to stop the underbrush from being burned off. They don't want the dead weight in the economy to be liquidated. And eventually we're just going to have a big fire like they had in California this past year, where all that just burns so hot that these self-proclaimed firefighters, who end up making the next fire even worse in putting out the current one, they're not going to be able to do their job. They're not going to be able to get the fire out. And if we're in that position now, which we may very well be, considering how weak the stimulus from QE and from money printing and from low interest rates, considering how weak that stimulus has been over the last 10 years, I don't know how that is going to save us from another recession. So if we do enter a recession, we'll in all likelihood still be at around the summer of 2020. Which now, back to our foreign policy tie-in, some of you may remember from my video discussing the likelihood of a war with Venezuela and Iran. I said that I think for now we're pretty safe, but I would wait for the summer of 2020 to see how Trump is doing in the polls. I said that if Trump is not doing well in the polls, he will start a war with one of those countries, probably Venezuela. Because he'll probably see that as an easier victory, because Trump knows that the most popular presidents were always wartime presidents, and so if Trump is able to start a war going into the election, he should have a higher approval rating, and he'll have people rally around him because they want to support the president during the time of war. And this is one reason why I keep such a close eye on the stock market. If things do go down, it's going to have ripple effects throughout the entire world. And so yes, as a result of the S&P 500 falling below, breaking through the key support at 2,800, you could eventually see a war with Iran. Or perhaps, now I don't think this would happen, but if Trump would, in the case of a crash, just let it burn. If we were to go into a recession this quarter, and Trump just decided to let it burn, I think that we would probably be out of it by the time that the election rolled around. I think it would be a very deep depression, but it would be necessary, and we would come out the other side with a much healthier economy. I know for a fact, though, that Trump will not do that. No president does it because it's political suicide. Unlike wars, depressions are not very popular. So if you gained anything of value out of this video, I'd appreciate you clicking that like button and subscribing. And if you do subscribe, please do click the bell, because I do upload every day and I'd hate to have you miss one. So I'll see you back here tomorrow.